Global stocks are looking at record highs from Asia to the US, driven by hopes for Fed rate cuts and the AI frenzy. But is this euphoria blinding equity investors to the warning signs being flashed by the bond markets? Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Alibaba is now driving the AI rally in Chinese stocks, with its shares surging on the back of a series of moves to shore up its artificial intelligence offerings. OCBC's head of global markets research and strategy will be joining us with her assessment of how fast and how far the global equity rally can go. Hundreds of South Korean workers detained in a U.S. immigration sweep are flying home on a chartered plane. Hyundai's CEO tells Bloomberg that the new battery plant is delayed due to worker shortages. As Korean firms grow wary of more crackdowns, we assess the future of their investments in the U.S. with a former U.S.-Korea Business Council president. We're keeping an eye on the trading session across Asia, with markets extending a global rally that's pushed stocks to a record high. The Asia-Pacific benchmark is on a 7-day winning streak and also closing in on a fresh record, while U.S. stocks are set another record. The latest U.S. inflation readings for August boosting bets the Fed will cut rates next week. Tech also leading the way as investors pile into stocks tied to the AI boom. Let's discuss how these tailwinds are all coming together for markets and bring in MLive strategist Mark Cranfield. Mark, it does seem like the stars are aligned. The path is clear for the Fed to cut rates next week.
It's not just about next week, actually. It is really about a series of rate cuts, which is what's getting investors excited about global markets at the moment. So if you look at the way that traders are pricing for the short-term interest rates, we're fully priced for an interest rate cut next week. We're pretty close to being priced for another 25 basis points in October, and we're not far away from following up with another one in December. So for the time being, people in the market feel fairly confident that we have 3 rate cuts coming from the Federal Reserve between now and the end of the year. Now, the reasons for that are not just about the weak unemployment data, which we've been seeing recently, and the steady CPI numbers. The dynamics are changing at the Federal Reserve, and they're going to change even more quickly in the near term, because Stephen Mirren looks as though he's going to be attending the meeting next week. Looks like the Senate will get through his vote on Monday. That will be in time for him to join the meeting next week. That will shift the narrative even more dovish than it may have been already, because obviously he is closely associated with President Trump, and he knows what is expected in terms of looking for more interest rate cuts in the United States. So he will be joining the Fed. But at the same time, we have the search going on for the next Federal Reserve chairman, who's going to be chosen initially by Scott Bessent with the approval of President Trump. Whoever that candidate is, once again, will be somebody who will have a mandate to try and lower interest rates in the US as well. So for the next few months, we're not just going to be driven by what's in the data, but also by who the personalities are at the top of the Federal Reserve, who are the ones who are making the big statements. And clearly, investors are expecting that they will be very favorable towards lowering interest rates a few times, not just once, but a couple of times into the end of the year.
Might there be a surprise, Mark? I mean, we talk about how, we're expecting 25 and then a further 50 through the end of the year. So 75 for the rest of the year. But could we see a 50 next week instead of 25?
It is certainly going to be discussed. It would be shocking if it's not on the table, because looking at the personalities involved in and don't forget, within the existing Federal Reserve members, there are a couple of them who would like to be chairman of they put their names down to be considered as candidates. So they will surely table the idea that we should at least discuss 50 basis points, that we may have got behind the curve, that these revisions downwards to the employment picture really give us the justification for doing a slightly larger interest rate cut as an insurance policy in case we've really misread what is going on with the US job situation. Personally, I suspect when it comes right down to it, they will go with a 25, but with a dovish outlook. They will give the indication that they're not finished, and that providing the data stays in line, providing the inflation readings between now and the end of the year continue to be as benign as they have been, that more rate cuts will be coming.
You talk about how it's not just about data, but when you take a look at the data, core CPI is still at a sticky 3+%.
It is, but then if you look at the way that the Fed measures, they have several of these averaging series, and on their basis, it's not so high. It's nearer to 2, or maybe even with a 1 handle now. They're looking at these rolling averages, which they have done for many years, and that smooths out the highs and the lows, and from their point of view, gives them more consistency. So they're more sanguine about the picture. Yes, some of the headline numbers look a bit high, but from the Fed's reading of it, it's not as bad as what it seems on the surface.
Mark, thank you so much for that. MLive strategist Mark Cranfield. Also with us for Macro Insights, Selena Ling, chief economist at OCBC, who's eyeing 75 basis points of Fed rate cuts by the end of this year. Selena, good to have you with us.
Thank you.
You know, I think we're looking at mixed signals when it comes to the stock and the bond market. I mean, how are you reading into that discrepancy?
Well, I think it's a question of, too much liquidity, chasing too few assets, and people are trying to, get ahead of this Fed rate cut trajectory. So they're basically piling into risk left, right, and center, and, the carry trades are all back. I think the equity market obviously is in a roll. They like the AI story. They like the fact that, lower interest rates are going to be here to stay for the foreseeable future. But I think the bond market is kind of caught because front end we have the rate cut story, but the back end we also know that probably higher funding needs over the medium term. So you see that the 10-year Treasury yield is kind of like testing the 4% handle. If next week, if we actually really get a bigger than expected rate cut, which is not, I think, our baseline for now. But, typically, if you look historically, when a Fed starts to cut rates, they don't do 1 or 2 and then pause. They tend to do a series. So I think it's very likely the story going forward as well.
But the thing is, markets seem to be underpricing risk, right? VIX at 15. That's really low when there's so much uncertainty out there. Here we're talking about how, both stocks and bonds are sending conflicting signals, and the fear gauge is very low.
Yeah, so things could go wrong, definitely, right? Because they're pricing in all the upsides from the lower interest rate story. They're pricing in, the AI delivering all the productivity gains and the benefits to the economy. They are kind of like putting the geopolitical risk a little bit under the radar for now. And of course, with some clarity on the reciprocal tariffs, they're kind of ignoring the potential for sectoral tariffs that may come, possibly as early as, 2026. So I think it's kind of like looking at the glass half full rather than half empty. People are trying to go with the flow. They are a little bit FOMO. They don't want to miss out on any action.
There's no stopping the momentum in the stock market. Isn't that true? So you just buy the dip. Would that be a fair strategy to adopt? It keeps testing new highs. I think we've seen 21, 22 new highs for the year.
I know, and it's very interesting because if you look at September's, it tends to be a challenging month for equity markets. But people are kind of like going with the flow and saying, with the Fed going to cut 3 times this year, possibly, 6 times from now, out to the end of next year, what could go wrong?
What could go wrong?
I think a lot of things can go wrong. As economists, we always think about what could possibly keep us up at night, right? So if the rate cuts don't come fast and furious, the market will have a little bit of a setback. If we have, Trump talking very hawkish on sectoral tariffs, you remember pharmaceutical semiconductor tariffs, he was talking about, 100%, 250%, those kind of levels, that could be a setback. And of course, we have this ongoing 90-day truce extension with China, right? So that's going to expire in early November. So there's going to be talks between the Chinese Vice Premier and, the Treasury Secretary next week in Madrid. If nothing constructive comes out of that, indicating that they have some progress towards a framework of an agreement by early November, market could also kind of like take a little bit of a breather from there.
The bond market seems to suggest a recession is possible. And the rate cuts which are coming are actually aimed at addressing the economy. But the economy is still pretty resilient. There is no recession possibility, is there?
I think if you look at the odds, at the beginning of the year when people were also worried about U.S. recession, and today, the fact is that the Fed has a lot of room to cut rates, right? And we have fiscal stimulus in the form of the One Big Beautiful Bill. It does look like the probabilities of an outright recession should be smaller compared to the start of the year, because both policy now inclinations are towards being supportive of growth.
So how do you position? What's the best play given the scenario that you've just painted?
I think short term, obviously, there's a bit of a momentum going beneath all the risk assets, whether it's equity markets or whether it's gold or whether it's Asian equities for that matter. I think everyone's building on this whole scenario that U.S. rate cuts will come fast and furious. U.S. recession will be averted. The global economy will kind of cruise into a nice soft landing into 2026. And, fingers crossed, hopefully that will be what materializes. But, for now, I think we're just cognizant that we're coming to the quarter end of September. And if the signals from the Fed are not as dovish as what is hoped, you could possibly get some retracement or pullback. And then, of course, with the new year, everything resets again.
And the best hedge against all the risks, would that still be gold? Gold's having its moment in the sun.
Well, I think gold probably has a lot of factors going for it right now. I mean, short term obviously is people trying to look for some hedge against the risk markets. But I think structurally also we see it longer term. If you're worried about some diversification away from the dollar, if you're still worried about policy uncertainty on the front of the U.S., and we hear a lot about central banks basically buying up gold for their FX reserves as a hedge. So I think it does have a lot of factors going for it.
All right. Selena, hang tight. Selena Ling of OCBC is staking around. Coming up, we take a closer look at China's tech sector as Alibaba stock soars after investors buy into big AI moves. The reason behind the rally is coming up next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on shares of Alibaba in Hong Kong as they gain the most in about 2 weeks after the company initiated a series of moves intended to shore up its place in China's AI boom. And we saw how its ADRs surged about 8% overnight. Alibaba currently up by about 5%. For more, let's bring in Bloomberg Intelligence senior analyst Robert Lee. Rob, it's all about AI yet again.
It is, and clearly the China tech sector, stock-wise, has regained its mojo for now. But maybe I can just try and add a bit of context and bring people back to some sort of reality, because I think some of the moves we're seeing in the stock market at the moment within the China tech sector are more driven really by, obviously, a lot of hype, a lot of headlines, and a lot of hope. Now, some of that hope is justified, given, I think, on the AI front, it's become clearer and clearer that China is making very strong progress, narrowing the gap with the US in terms of technological development, with DeepSeek being the shining example this year. So I would give them, 9 or 10 out of 10 in terms of technological development. But the point I continue to come back to is monetization within the sector. It is increasing from a very low level, but it remains extremely low in the context of these very large amounts of capex that are being spent. And just to throw one quick statistic at you, Alibaba's capex trebled during the 4 quarters ending June. So it went up to about $5.4 billion US from memory. Yet the incremental increase in profit within their cloud intelligence business was just $86 million. So they made an extra $86 million on a trebling of capex. That's a pretty poor return on investment, I would say.
And Rob, when it comes to Alibaba, it's also the food delivery business, right? I mean, big questions about whether or not, what they make from AI can counter what they're experiencing in terms of price war in food delivery.
That's true, and obviously they've upped the ante on that front, and there's clear evidence that they are gaining share, but again, at what cost? Because food delivery, it's an essential service for most people these days in developed economies, but it's a low-margin business at the end of the day. So I think there's plenty of evidence to support the fact that Alibaba's making headway, pressuring the likes of Meituan, which is a dominant player in China, but that's coming at a cost to the bottom line in terms of margins and subsidies. So again, I think if you take a positive stance, the headline growth at the revenue level, both from food delivery and cloud, is increasing. So that's great, but it's coming at a huge cost to the margin. And actually, if you look at consensus numbers on Alibaba, they've actually been downgraded significantly this year, which is why I return to my opening comment. Hype, hope, and headlines were really driving this, and a lot of local money behind this move as well. And I would just, we know that can be quite volatile. So, has this rally got a very strong fundamental underpinning? I would say no, it hasn't. And that obviously brings obvious risks and dangers.
And we hear you loud and clear. Just one final question before we let you go. Rob, in terms of AI development for Alibaba, what are we looking out for? What's possible? What will excite the market?
Okay, well, they've, as you've seen, there's been a continued flurry of model releases, and I would say to give them their full dues, Alibaba has clearly moved into a lead of market leadership. So maybe that's got investors really excited. I think a week ago they launched a 1 trillion parameter model. So that gives clear evidence that China is narrowing the gap with the States in terms of technological developments. But again, when you're spending humongous amounts on capex, there needs to be some prospect of an ROI and a return on investment. And for where I sit at the moment, that remains hard to see.
Rob, thank you so much for that. TGIF, Robert Lee, Bloomberg Intelligence Senior Analyst. Well, Selena Ling, Chief Economist of OCBC, is still with us. Are you liking Alibaba? When you take a look at, the kind of comeback we're seeing right now, it coincides with, I guess, China propping up its support for technology.
Actually, this is a very familiar playbook. It's also playing out in the US, right? We also had another company talking a lot about AI capex investments and a lot of that hope being built into the market. So the irony is that there's a bit of a disconnect, right? The equity market, especially on the tech sector side, and the real economy. So next week we get a lot of Chinese data. At best, we are looking for some stabilization. No one is really expecting that growth is going to be as strong in the second half as compared to the first half. But obviously, on the tech sector, there's a lot of retail money coming in. There's been a flood of ETFs. People like the AI story. People think that national objectives is to try and narrow the gap between the US and Chinese high-tech sector. So it does look like it has some near-term legs to run. But the question really, can it deliver?
Can it deliver? What's your take? How are you assessing the risks, from the love that's being shown to the likes of Alibaba and the other tech plays in China?
I think tech plays are in favor because people buy into this story that AI will deliver benefits for the real economy. A lot of investments will continue to flow into this sector. But what's questionable is the productivity gains, the real benefits to the specific sectors at this moment. We see a lot of it on the capex side of things. We don't see so much of it showing up in the hard quantitative data yet. So I think over time we will probably need to see some translation into that side of the equation. But it's like what Rob said, everyone's just looking at the hope and the hype and the headlines.
How about the Chinese market as a whole? It's been a red-hot market, and I'm just wondering how sustainable that is as well.
Well, it depends on who you speak to, because onshore there is a bit of that fever that's ongoing. But I think if you talk to outsiders, they may still say, well, for the Chinese market, it's still facing a lot of external headwinds. The tariffs are not going to go away. They don't have a trade agreement with the US yet. There are still specific issues, with the high-tech sector. It's going to be challenging going ahead. Of course, China has a lot of resources, right? So if the government puts its mind behind certain objectives, they can try and, of course, push ahead with the agenda. But it's not like it's going to be a bed of roses. The external environment today is very, very different.
The external environment is different, but there's still optimism that China's economy is showing some kind of resilience, especially the markets. Is that trickling down to the rest of Asia, especially in Southeast Asia?
Well, Southeast Asia has been benefiting from obviously the expected rate cut story and of course some of the momentum that we see in the Chinese markets as well. It's hard to say because I think that if you look within Southeast Asia itself, you also have a little bit of idiosyncratic issues, right? I mean, we saw the issues with, the changeover in Indonesian finance minister. We saw the changeover in the Thai prime minister and also with Japan. But I think generally people are kind of like focusing on the broad levels. It's going to be a low interest rate environment. Chinese growth is going to be relatively stable. We're not looking at the US recession. So let's just look at the glass half full.
But not to mention as well, the weaker dollar, that's all supportive of risk assets and EMs in particular.
Yes. So EM typically tends to benefit when the dollar is weaker. And it does look like the US administration has basically given the green light for a softer dollar. And that gives a lot of breathing room for EM markets.
We've seen that rotation. We've talked about the rotation out of the US into the rest of the world, particularly in Asia. Are we still seeing that? Should we be talking about that?
I think we do see some of that money coming back into Southeast Asia. Bond markets, for instance, in particular markets are starting to see greater inflows. I think the expectation is that as the Fed cuts rates, significantly over the next 6 to 12 months, that kind of narrows the yield differential gap that we have over certain Southeast Asian local bond markets, and that's going to be fairly attractive, I think.
And India too.
India, definitely. India has been a big beneficiary, both from if not China as the production factory of the world, who is the alternative? A lot of people look to India, but also in terms of investable markets.
Selena, is the market missing anything amid all the optimism right now?
I think at the end of the day, if you take one step back away from all this hype and the headlines, the fact is that tariffs are here to stay. They may be a little bit lower than what was initially announced during the Liberation Day, but they are here to stay. And if anything, you're going to get sectoral tariffs on top of reciprocal tariffs. So it's going to be challenging on the trade front. It's going to be challenging on the growth front as well, right? So we have to have a bit of caution on the growth prospects from here. I think the other point really is that if you look at the geopolitical situations around the world, the conflicts that have been here for a while also doesn't look like it's going to go away anytime soon. If anything, occasionally we get a little bit of tremors here and there, new attacks. So that kind of like gives you a little bit of a reality dose. But I think at the end of the day, markets look at it as in the key central banks of the world, the Fed, the ECB, the BOJ, balance sheets are still very, very elevated. There is still a lot of liquidity support. Interest rates are coming lower, and that generally tends to be supportive of a risk environment.
Selena, thank you so much for that. Selena Ling of OCBC, still to come on the show. The former U.S.-Korea Business Council president will be with us as we take a closer look at the impact of U.S. immigration laws on foreign businesses. Keep it here with us. Welcome back. Citigroup strategists see more upside in the coming months for global stocks, especially in Europe and Japan. They see two likely scenarios, either a soft landing boosted by Fed rate cuts leading to broad gains, or more economic weakness leading to a growth is defensive strategy. Citi suggests investors split the difference and go overweight in Europe and financials while also sticking with U.S. mega-cap growth stocks. Citigroup CEO Jane Fraser is also seeing growing confidence from investors. She spoke exclusively with Bloomberg on the outlook for client investments and how lender is navigating growing geopolitical risks.
You've got to look at the collective impact of the tax policy, what's been happening with tariffs, and indeed the increasing deregulation that we're seeing, and they work together as a package. I think the most important piece for a corporate, clarity. We hate uncertainty. We like clarity. And our client base now is really starting to act with more confidence now that we've got clarity on those three fronts. So active in the capital market arena, in financing, much more active in investing, less sitting on the sidelines, and M&A has been very, very active indeed, as we talked about. And on the consumer side, pretty robust spending through the summer. And we saw that really across all categories, helped a bit by lower gas prices. But the consumers being fiscally responsible, being more mindful around some spend, but still the spending levels were very pleasing.
So the momentum was pretty strong across all lines of your business in the second quarter. Of course, I don't want to precipitate the upcoming earnings, but can that momentum continue into the end of the year, just in terms of what you're seeing in advisory, in deal making, and in trading? Because it was a very strong quarter for trading as well.
It was exceptional for us on all fronts. I still see very strong pipelines. I see high level of engagement from clients. I see a sense of urgency as well, given the speed with which industry structures are changing, and there is still growth opportunity. I think growth will be a notch lower. We're keeping an eye on the labour market. It's a low churn market. So not everything is rosy, but we don't see a recession on the horizon.
So Citi increasing, global bank, obviously establishing here your presence over here as well. But at the same time, we talk about multiple geopolitical shocks. At the top of the show, we were speaking about the latest Russian incursion into Poland. We talk about geopolitical risks over here. We talk about tensions between U.S. and China. As a bank, how do you navigate all of those potential geopolitical sensitivities and the barriers that are going up around the world?
We're in doing business in about 160 countries around the world. We have local banking license, people on the ground in almost 100. And we've been in many of these countries for a very, very long time. So this isn't classic suitcase bankers fly in, fly out. There's a really deep knowledge of what's going on. And a lot of the services we provide are what help the economies and the companies do business every single day. So for us, there is a mission to make sure that we are operating with resiliency and with rigor to support our clients. And we tend to move activity around the world as clients ebb and flow in different geographies. So the Middle East is probably on a rip for the next decade or so in terms of how much investment and new industries, new clients coming in. Other areas we'll probably see some more diminishment in. So we flex where it is. Our people are globally minded. They move around the world as to where opportunities are. And it's a moment where Citi shines, where there is volatility. The clients need us.
Well, Middle East, a riff on the next decade. That's a good headline, Jane. I do want to bring it back to an article that Bloomberg published a couple of weeks ago that Citi had hired an external counsel to look into some allegations that were made against your global head of wealth, Andy Sieg. You've not commented yet on the outcome of these investigations. Are you satisfied with the outcome?
Look, I gave Andy a very clear mandate when he joined Citi, which was to transform our wealth business. And I'm very pleased with what he, the team and the business have achieved in terms of transforming it. If you look at our investment revenues really since the beginning of the year, they've really outperformed. They've been very strong. We have a terrific team. And I'm very comfortable with the direction that we're going.
And that was Citigroup CEO Jane Fraser speaking exclusively with Horizon's Middle East and Africa anchor Jumana Basachi. Coming up, Gautam Adani's push to settle U.S. fraud charges has apparently hit a wall amid heightened tensions between the U.S. and China. Details coming right up. This is Bloomberg.
We're here illegally, but we do have to work something out where we bring in experts so that our people can be trained so that they can do it themselves. Does that make sense? Right? Is it straining the relationship with Korea at all? No, we have a great relationship with South Korea.
사실은 당황스럽죠.
To be honest, it's baffling. But I think this also reflects some cultural differences between South Korea and the United States. This could probably have a significant impact on future direct investments in the U.S. Therefore, we are negotiating with the U.S. to ensure that visa issuance related to such investments is handled properly, whether by securing more visas or creating new types.
President Trump and South Korean President Lee Jae-moon addressing the recent immigration raid on Hyundai LG's battery plant in Georgia, which saw 475 mostly Korean workers rounded up by U.S. immigration officers. Hyundai CEO Jose Munez told Bloomberg that construction on the raided battery plant is being delayed due to labor shortages. He added the project could be held up by at least 2 to 3 months as they face challenges in finding workers. The over 300 South Korean workers swept up by ICE last week are expected to arrive in Seoul this Friday via a chartered plane. The recent U.S. immigration raid at the Hyundai Motor LG battery plant in Georgia could impact future investment plans by foreign companies in the U.S. due to ongoing labor shortages. Let's get perspective from Tami Overby, former president of the U.S. Korea Business Council at the U.S. Chamber of Commerce with more than 3 decades of experience working in Asia. She advises clients on investment and trade issues in South Korea and across the region. She's currently a partner at DGA Group, a global advisory firm. Tami, good to have you with us. What we have seen so far pretty much underlines the limitations of U.S. immigration policy that we have seen for years now.
That's correct, but it's quite shocking in the way it's been, this raid has been implemented. To see hundreds of Korean hardworking construction and supervisors being treated as hardened criminals is shock all across Asia.
You got to imagine that everyone is looking at this. I mean, it's not just the Koreans, but also those in Taiwan, in Japan. How do you think this might impact their investment decisions?
I think everyone is going to have to take a pause, take a beat as they try to evaluate how this is going to play out. The reality is America's professional visa system is capped at 85,000 visas per year. That's given out by lottery every year. As soon as that lottery opens, in a matter of seconds, those 83,000 are gone. And so companies, American companies, foreign companies, anyone trying to secure professional visas from abroad have challenges. So I think everyone is waiting to see what's going to happen next.
Tami, this comes down to a labor gap, a skills gap. How do you see this playing out?
Well, ultimately, the goal is for South Korea to bring and transfer their management technology and talent to American workers. But before that can happen, the plants and facilities have to be built. And even to do the building of these high-tech advanced manufacturing facilities, the U.S. does not have enough resources. And someone asked me, why are Koreans sending over hundreds of workers to steal American jobs? Apparently, those folks are not aware that the cost of an airline ticket from Seoul to Atlanta is a couple $1,000s. So Hyundai's not, and LG and their subcontractors, they're not sending Koreans over here to pour concrete or build a simple house. These professionals have technical skills that are needed to build this type of advanced manufacturing.
Is there a need for, I guess, an expanded visa categories in the U.S.? There's already an alphabet soup out there. But given what has just transpired, what has just happened, is there a need for that? And do you see perhaps more lobbying for this to happen?
Absolutely. Not just for the dozens of Korean companies that have massive construction operations going on now to build these plants so that they can hire tens of thousands of American workers, but as you mentioned, Taiwanese companies, Japanese companies, American companies, and all of the deals that the Trump administration is making with our trade partners include parts of agreements where these countries agree to invest in America, to build it in America, to avoid these reciprocal and sectorial tariffs. So we've got to have a solution to this visa problem, and we need it sooner rather than later.
We know that trade negotiations are happening between the U.S. and a lot of the other trading partners, and Trump himself is very keen to bring investments back home. How do you see this impacting the appetite to actually invest in the U.S., particularly between, the U.S. and Korea?
It's creating tension. It also highlights the competing Trump policy priorities between immigration sweeps and attracting the investment. But any current investor or potential investor in the U.S. has got to take a pause and determine whether or not they can bring much needed professional skills, talent to the U.S. legally. No one wants to break U.S. laws, and unfortunately, I don't believe any of the employees in this sweep are Hyundai employees, but the name that's mentioned in most articles is the Hyundai name. In fact, I saw Hyundai stock this morning took a hit because of this. So I think companies are going to be cautious, and they want to see what the U.S. is going to do to resolve this U.S. problem of not enough visas for skilled workers when we clearly have a labor shortage of that skilled labor.
So what do you see the U.S. doing, and how soon do you think that will happen?
Well, we have to expand the quota, take the cap off. Again, as I mentioned, it's a cap at 85,000. I believe that cap needs to be removed. But in order to do that, we're going to need congressional action. So I think probably there's going to need to be a push, perhaps a coalition of companies to help encourage Congress to move. I think the president is aware of this and says we need to move quickly, and we need to work together to make it happen.
The problem is the U.S. itself. It wants the investments. It wants the knowledge. Could Korea use this as a leverage, you think, in their negotiations with Trump?
I'm not so sure they could. Certainly, Korea has what the U.S. wants, whether it's semiconductors, EV batteries, shipbuilding. They have skill sets and technology that the U.S. wants, and President Trump has shown a flexibility to help us get that. But I also think that Korea needs the access to the U.S. market. And Korea also needs, we are a strong security partner, and we are the security umbrella for South Korea. So I think President Lee has to play this very carefully. But, the Korean companies are going to be understandably cautious about moving quickly until this U.S. problem is resolved.
Tami, what are you advising your clients to do on the back of what has happened?
Well, right now, I think they need some serious crisis management and communications because there's not a lot of people out there telling the very positive story of South Korean investment in the U.S. I read some of these articles about Americans complaining that these Koreans are taking their jobs when, in fact, these Koreans are investing billions of dollars to build these advanced manufacturing plants to help America revitalize our advanced manufacturing, and they're bringing their technology, which we do not have, particularly in the areas of semiconductors, electric vehicles, vehicle batteries, shipbuilding. And we need this for America's economic security.
Tami, thank you so much for your assessment today. Tami Overby, former president of the U.S. Korea Business Council at the U.S. Chamber of Commerce. Well, it has been trading for about 2 minutes now. Let's do a check on where the Nifty index is. It's risen in the last 7 sessions, marking its longest streak of gains since April. Some suggesting it is time for some consolidation. That is not happening today. It is extending further. Sensex up 0.3%. Now, staying on India, billionaire Gautam Adani's push to settle U.S. fraud charges is said to have hit a wall. That's as the U.S. and India clash in recent months over issues such as trade and oil. Let's bring in Bloomberg reporter PR Sanjay. Sanjay, where are we with this?
Hi. First, thank you for having me. First of all, this is a developing story. And, the billionaire Adani effort to get U.S. fraud charges against him and a few other officials, including his nephew, have stalled now, and there's no progress. And if you see, there's no progress at all for the investigation also. Earlier, it had gathered momentum, and they were hoping to conclude or reach a settlement in April, but with this kind of a tariff tension and disputes of bilateral tensions emerged between India and U.S., this has been stalled, and the progress Adani's representatives have been making with American officials have faltered in the recent months as the U.S. and India have clashed on the issues like trade and especially Russian oil and India's conflict with Pakistan. And they were hoping to resolve soon, and so that they can get into the normal course of business. And they had promised a huge $10 billion investment in the U.S., and they want to revive that. But with this kind of a bilateral tension emerged, it has now, the progress has slowed. And what we pick up from sources that the investigation has not moved at all. And we might be filing a status report saying that no progress. The sources are expecting that would happen in the month of October, but that's the scene, that's the latest.
You got to imagine that as it tries to expand its business, expand its footprint, now it's unable to tap U.S. lenders and secure all the deals it was looking at.
That's not true because, post this indictment, Adani Group has successfully raised some funds, including high-profile U.S. U.S. fund houses also. So, per se, the expansion program is progressing. But, of course, it's not that easy. They will have to put a lot more work to convince the high-profile U.S. lenders. But, since the investment in the U.S. had stalled, they are looking for expanding the other areas, including Africa and Middle East, etc. And that is going on. And they are getting U.S. investors as well. But they have to put additional efforts. And right now they are going and meeting global investors also. And they are on roadshow, and they are trying to convince that this will be settled soon.
Sanjay, thank you. Bloomberg's PR Sanjay there. Now, the death of Singapore's second richest man has made 6 of his grandchildren billionaires after they inherited stakes in his paint empire. Goh Cheng Liang, who died last month at 98, left behind a clear succession plan, dividing assets and control among his second and third generations, a rarity in Asian dynasties. To break it all down, let's bring in Bloomberg Wealth reporter Felipe Pacheco. Felipe, what do we know about the billionaire heirs?
Hi, Haslinda. Very interesting case, very interesting story from Singapore, as you just mentioned. We know for sure their names. It's all public. It's the ones that you see in our chart right now. This is all widely known because it was part of filings of the stakes that they own in this company that is listed in Japan, Nippon Paint Holdings. It's part of a very big conglomerate, part of an empire that Mr. Goh Cheng Liang basically put together and built throughout his life. He was 98 when he passed last month in Singapore. And before actually the date of his passing, there was a distribution of a huge stake of his fortune among those 6 grandchildren. Actually, he had 8 grandchildren. One of them is actually holding assets for 2 others, for 2 siblings. And we know that all of a sudden, these names that were completely unknown for a lot of investors or for a lot of people within the business community in Singapore, well, now they are definitely billionaires, each of them.
So it's a pretty unusual way of succession. Why is this case so particular versus other Asian dynasties?
That's correct, Haslinda. We spoke to a few specialists. We tried to understand exactly why this has been put together. And what we can tell for sure, this is very well planned. It was very well structured several months ago. And there hasn't seemed to be any disagreement. There wasn't any fight. There wasn't any, let's say, misunderstanding among those that were the heirs. We had 3 children of Mr. Goh and 8 grandchildren. And the distribution of the assets has been quite clear, as we just spoke about. But then the control of the voting control, let's say, the 91% of voting rights within the stake in the Japanese listed company is actually held by his eldest son, who is the chairman of the same company. So decision-making is still kept within the second generation. What makes the whole structure even more interesting, because there's a clear indication that the assets were passed to the third generation among agreement between all of those involved, and then the control, the decision-making is still with a professional who is also part of the family and has been a familiar name to the company for many decades now.
Felipe, we know that Mr. Goh loves boats. Do we know who's going to take the mega yacht White Rabbit?
Haslinda, that's a big question. Maybe you in Singapore can help us answer this later on. Right, he had several white rabbits. The latest of them is a gigantic one. We do not know who is going to be the one with the white rabbit under their name, but apparently the family is going to keep enjoying it. It's a gigantic and it's a beautiful boat. So if you happen to know anything, please share with us. We're here waiting for that update.
I shall take a look to see whether the White Rabbit is, in fact, in Sentosa. Bloomberg Wealth reporter Felipe Pacheco, thank you so much for that. Now, coming up later, watch for the next episode of Bloomberg Tech Europe. We'll be looking at how AI is changing the way we fight disease, including an exclusive interview with Demis Hassabis, CEO of Isomorphic Labs and Google DeepMind, that's airing at the Times on your screen. And before we go, here's a look at our guests. Next week, we'll be heading to Super Return Asia here in Singapore on Tuesday for interviews with AZVC Managing Partner Jack Selby and Raisewell Ventures founder Jeep Klein. Plus, we'll break down the Fed's rate decision with Barclays Global Head of Research RJ Rajadiksha. And don't miss an exclusive with Trip.com Group CEO Jane Sun. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.